Hey, welcome to the podcast, everybody. Thank you for joining me. Today is February 3rd. It's a Monday, and it's a bloody Monday. Red on Wall Street, pretty much across the board. Dow Jones down over 2%, 325 points, pretty much closing on its lows of the day. S&P down 40 points to 1742. By the way, the Dow is now down to 15,373. NASDAQ down over 100 points, 2.5%. Mid-caps and small caps really got beat up the most. And, of course, on the flip side, it's the opposite of last year. You've got the gold rallying, treasury bonds rallying, volatility index rallying. So it's just a complete 180 from 2013. Well, what's got the market all in a tizzy, or investors in a tizzy? Really, we can go back all the way back to a few weeks ago when the weak jobs report came out, much weaker than expected. And at that point, based on all the evidence, it looked like something was up with that number. Something was goofy about that. And then, so the market kind of dismissed it a little bit. And then we got talk about tapering. Right, they're going to start tapering, and of course the market actually rallied on that because, well, the economy was okay and the Fed was going to start tapering and getting out of the way. That's a good combination. So we got the weak jobs report, then we got the weak China economic data that came out of manufacturing, and that's really when things peaked out and had a really, really bad day, and things started to go down from there. This morning, you got the weaker than expected manufacturing data here in the United States. Okay, so you can see here, this is the manufacturing PMI for the U.S. It goes all the way back to the year 2000. So you can see we were heading down into the recession. Things were starting to slow a bit. And then, of course, it fell off a cliff, recovered. And it had been kind of slowing a little bit in 2011, 2012. And then we got this resurgence in 2013. Now, when I look at this picture, something stands out to me, which is right over here. It came in at 51.3, much lower than expected, much lower than last month. Look, people, the companies and everybody always blames the weather for everything. And I've talked about this in the last couple of podcasts. They always blame the weather for everything. This time I think it may be some of the weather. And the reason I say that is economies don't just fall off a cliff like this. And granted, this is still above 50. 50 is kind of your line in the sand between contraction and acceleration or expansion. And so at a reading of 56, 57 like we've been getting the last few months, that's really strong. And for it to drop as much as it did that quickly, something tells me that these are going to get revised. And now, having said that, I don't think that this would have made a new high this month if it wasn't for the weather or anything like that. I think we are entering a soft patch. We can see it from China. We can see it in the jobs report through the U.S., all of that. I think it's a soft patch. Are we entering a recession again? No, but based on this data, it sure looks like we would. I mean, it looks like one more month and we'd be in a recession. And I don't think that's the case at all. So I think what's going to happen here is that the market is probably shooting to the downside too much and will bounce at some point. Now, here's the thing. The manufacturing fell off a cliff, as we mentioned. That kind of scared investors. The other thing that came out was the ISM manufacturing prices paid, and it actually jumped more so than people thought. So you have this big number right in here, and that spooked people because look, this is the recipe for the worst combination, and I mentioned this before a couple of weeks ago, I think, or maybe last week. If the economy is weak, but the Fed is implementing quantitative easing, buying bonds, the market seems to be okay with that. If, on the other hand, the economy is strong and the Fed is tapering or out of the way, the stock market's still okay with that. What they're not okay with is weakening economy combined with tapering, and that's what we have right now. That's a bad combination. Now, again, we're only talking about a couple of weeks here from a few data points, but this is what has investors so scared. This is it. And when you combine that with prices paid higher than what we see here, then it's even worse because now what you're saying is, wait a second, you're telling me the consumer is going to get squeezed here while the economy is getting weaker and the Fed's tapering, holy cow, sell stocks. And that's what's leading to this selling right here, okay? That's the reason why we're getting the selling that we're getting. We were already high. Markets were looking for a reason to sell, and you've got this combination together. Now remember, the Fed can always put it on pause. They can taper the taper, right? They can do that. But I think some of this data is going to get revised higher. So I think it's a knee-jerk reaction to assume that the economy is in horrible shape. Again, we are going through at least a soft patch based on the numbers that we're seeing, okay? And what's happening now is because we're going through that soft patch, you're getting the retailers and companies like that really getting hit hard. I mean, if you take a look at retailing stocks, this is really ugly, folks. They're not only are they breaking, these 100-day moving averages, now it's clearly broken the 200-day moving average. So those stocks are getting really beat up because, again, if prices paid's going up, that means commodities are going up, and we've been seeing commodities going up. So the restaurants and places like that are having to pay more for the items that they serve to you, and you potentially have less money in your pocket, and so they're getting squeezed. You're going to get squeezed. So that's really the issue in the short run here. That's why you're seeing retail do so poorly. Now let's go back to the market for a minute because I actually owned in my aggressive strategy, I owned this Russell 2000 short position, and we bought it just a few days ago, and basically locked in the gain this afternoon, right into the close. And the reason I did that was for a couple of reasons. Number one, I think first of all you have to, if you're managing your own portfolio, you have to basically take the portfolio and break it up into pieces. Okay, the pieces are your liquid cash, safe money, right, that you have there for emergencies, a new roof, whatever that might be. And then you move it up to, okay, what part do I want that it's mainly a little more safe, but, I can afford a little bit of risk, but it's safe, and I'm really just looking for income. That's another pile of money. Then you may have your core positions, kind of your, hey, I'm going to keep some money in the stock market through thick and thin no matter what. But you have your aggressive, more of your tactical money. And this is the part that you do more of your trading with. And that's the part that you look for stocks that are trending up, or you're looking for things that are beaten up, or whatever the case may be, and that's your trading money. That portion of the basket that I'm doing, that's the opportunistic part. And so that's the part that I said, hey, look, we've got a nice gain in this. It worked. The stock market has fallen here. Let's lock that position in. And what we're looking for now is we would love to see a bounce and potentially establish the short position again. Because, look, let me tell you what's going on here, is at least the way I see it. There's a lot of different scenarios, but I see this potentially setting up where you have this shoulder, head, and then another shoulder happening. And so I think you could bounce up into this range a little bit, only to fall back down. And if you do that, you come back up into here somewhere and then start to head back down. I thought that was a potential pattern, and I still think that's the case. We're getting oversold in the very, very short term, and we could see a bounce. But here's the thing. The reason that I shorted, and I mentioned it on Twitter, for those that want to follow me, twitter.com/Carl Eggers, but I talked about selling some into the close on Thursday because we had this rally here. And what I was looking for was a strong, remember we had this 90% down day, and I said a bounce is likely, but we would need to monitor the bounce. Well, the bounce was very weak. And so when we had that up day on Thursday, we went ahead and sold some more items that day because it was a weak showing. And you need strength. You need convincing strength to convince me that the selling's over. And that wasn't the case. So we actually shorted at that point, and we saw the drop today. But when you get these whoosh downs, again, after another 90% down day today, you would expect some type of bounce to at least establish shorts at a higher point. But we're going to get to a point where this is oversold. We're going to rally, and when we do, it's going to make some people think that it's over. And I don't know if it's over or not. Here's what would convince me it's over. We've had two 90% down days now, where you have these just, for all intents and purposes, you have these days where you just basically everybody just gives up and sells stocks there and there. Those are the two. If, let's say, we open tomorrow down and reverse in the middle of the day very strong, or we have a 90% up day, that would tell you that the selling is over. It's exhausted to the downside, and now you have strong conviction on the buying. That would say that the correction is over. But I don't think it's over just yet. I think we will have more weak rally attempts because some of my medium-term indicators are signaling that, hey, something's different now than all we saw in 2013. But having said all of that, your longer-term positions, I wouldn't be going whole hog here and shorting every rally and going net short. That's let me be clear about that. I am using shorts on my aggressive strategy simply to hedge some of the aggressive positions that are more volatile. Okay, our rotation strategy we have has about 50% cash in it. We have other positions that get more conservative over time as things get breached, but we're not there yet. But I would point out to you that if you kind of zoom out of the market here, remember we were in this trend and we kept saying, hey, everybody keeps watching these moving averages. Let's you and I look at the one that matters. For the S&P, it seems to be the 100-day, and it's broken it a little bit, but for the most part, it's held it. Well, this is pretty low now, isn't it? And so it certainly looks like the 200 is now in play, and we could certainly get down to that level after maybe some bounce. But I want to step back for just a minute and discuss the difference of corrections and bear markets. I first want to point out that we have the average drop during the middle of a year for the stock market since 1980 has been 14.7%. The average drop, okay? So far on the S&P 500, we have seen 5.67%. That's just 5%. The average has been triple that, okay? Triple that. That's the average. So for us not to have one 10% correction in 2013 was very rare, very rare. And I did see some complacency at the end of last year. Just, again, people wanting to shift everything that they have been working for and basically the whole financial plan and scrapping it and just going with all stocks all the time. And now what we're seeing is, hey, bonds do work at times, stocks work, commodities work at times, cash works, trading, shorts, those things work. This may be more of a normal year where we don't see up 20, 30 or down 20, 30. Maybe we just get volatility and we end up 3, up 4, down 5, right? We haven't had that in a while. So maybe we get something like that. But let's examine this for a minute. So if we know that the average is a 15% drop and we're only at 5.67, we could fall further here. The question is, what are you going to do about it? Are you playing for tomorrow, or are you playing for the next 6 months, year, 5 years? What are you going to do about it? Well, let's first go back and kind of look at what's the difference between corrections and bear markets are. So this is a picture first of the 90s, the late 90s. Remember the fabulous run from 95 to 2000? We had 1, 2, 3, 4, 5 corrections, and you would even consider technically it's bear market because corrections are anything from 10% to 20%. Bear markets are 20 over 20. I would define them as more the longevity than how much they fell, because I still view this, even though it's 22%, as a correction. Now, the similar thing I think we're going through is kind of like 97, where we had a real violent 13% sell-off in late 97 due to this Asian crisis where the Thai baht fell. And it's very similar to what we've been seeing with Argentina and Turkey right now, where their currencies are falling very fast and everybody's starting to take notice, combined with the weaker economic data. But here's the thing. All of these were very headline-driven, and they just came out of nowhere. The markets were running up, making new highs, and then boom, they sold off very, very quickly, just like here. So again, it's not uncommon for us to have corrections in a bull market. And I still think we're in a bull market. Now, every bull market does have a peak, right? By definition, there's a top somewhere. But I think bear markets are more of a process. Those happen over time. Here's the 99 to 2000. Even this horrible dot-com bust was a process. You got real violent sell-offs, okay? You made new highs, violent sell-off, and then it would rally back and then sell off and then rally back, sell off, rally back. It started making lower highs. It was a rounding off, and this is over a 18-month period that this rounding off happened. So that's what happens when it's kind of a prelude to a bear market. And so we could have seen the top. See, I'm not saying we didn't necessarily see the top, but I think you get plenty of chances to sell, and you have, this process that's rolling over time. You don't have these violent sell-offs. Just like here, if you notice here, this was the top in March of 2000. You had a horrible sell-off, but then it came back and you had a time to sell a few months later. Just a lot of people didn't at that point. But what was different here was there was a lot more deterioration in the market than here. So this was a process during this whole time frame. How about 2007? That was one where a lot of you became listeners to the podcast and to radio shows and all that because of the fact that that time I was talking about that we're seeing deterioration in here. The markets were making new highs, yet there had been deterioration happening for several months. And again, violent sell-off in July of August of 2007, but it rallied all the way back to old highs. So what we would need to see is if we get another rally to highs, is it the same quality that we saw in the previous high? And if it's not, that's how you know that we're starting to roll over and it's becoming a bear market. But you do not get bull markets turning into bear markets overnight. You usually get corrections happening. Even since 2009, we've had a 17% drop in 2010. That was during the flash crash. We had almost a 22% drop when our debt was downgraded in 2011. And then in 2012, we had an 11% drop. And so, again, not to expect this thing to pull back a little bit. Of course it's going to pull back. But when you get these violent sell-offs, it's more of a buying opportunity than it is a selling opportunity. Now, you may want to sell, but don't sell it when it's down 300 and some odd points. You sell it after it's been rallying and it's weak at that point. It's a weak rally. We're not getting that. We have the violent part, the sell-off right now, very headline-driven, right? And then what we would want to see is some positive news. The market rallies up, and if there's no intensity to that buying, that's when you really sell aggressively. The reason we're shorting and covering those shorts on our aggressive strategy is simply more of just short-term trading, really. This has nothing to do with the big picture of what's going on here. I still think ultimately this will be a buying opportunity. And the reason why is just because, again, I think some of this economic data will actually show better reports in the coming weeks, and some of this will get adjusted up. There's no question, though, we're not going to sustain a 4% growth rate in the GDP like we saw. That was a moment in time. But things are still improving, and yet we're still getting some bad data. But for it to fall off a cliff like it did, to me, something's fishy with that. And I do have to think some of it is weather-related. So throw me in the crowd of people that think it's weather-related. But I do. I think it is. So I don't think I've ever blamed it on the weather in my whole career. But I think actually what you saw in the last few weeks did affect some things in the short term. Now, the problem you have to have is that if people start believing it, self-fulfilling prophecy that, hey, the economy's weak. I saw that it's all over the news now that market's going down. And so you start to see people kind of, get a little more scared. But we are seeing the fear pick up. And remember, when fear picks up, we want to see when it abates, and that's the time to jump on it. Now, this is our fear and greed indicator. And you can see here the fear is spiking right now, but I've drawn these blue arrows. Just went back a couple of years. You can go back to 10 or 11. But every time the fear abates, that's when you want to jump on the market. And you can see these black lines for good buying opportunities. Even here in 2011, when it finally came back down, that's when the market bottomed. So you don't want to be buying when the fear is escalating. And you can certainly jump the gun. And I think if you have short positions, you do want to sell those sooner than later or cover those shorts sooner than later. But to buy new positions, you usually want to wait, unless you get a big whoosh down, you want to wait until the fear abates a little bit. And right when it starts to abate, maybe it's in the second inning of abating, that's when you want to buy. So just from a technical perspective, again, I think the S&P right now looks destined to come down to at least 1723 and probably the 200-day moving average, but it will not go in a straight line. And again, I don't think that the bear market has started, okay? I don't think that at all. But are we starting the process of the bear market starting to where, we could easily rally up here and still be contained within a bear market as it's rolling over the next several months? Absolutely. And that's why we got to we got to be open-minded. And I always have this section in our client newsletter called the agnostic investor, because we need to erase kind of our biases and what happened in the past and just deal with the market we're dealing with. If you're ultra bullish and the signals are telling you that things are getting worse, then you need to adjust to that. And so that's why right now we have made adjustments being a little more negative than we were. But if things get too far negative, obviously we want to take advantage of that as well. So again, just to recap, in the very short run here, we are looking for a bounce. We think we are getting really, really oversold in the very, very short term. We think it will bounce. And when it bounces, again, if we don't have a huge intraday reversal or some type of, all-in day where everything's up, it's kind of the opposite of today. If you don't have one of those, then they are still going to be selling opportunities. And how do you do that? You hit the sell button. You can sell stocks. You can short all types of things, build cash. But for right now, don't sell when everybody else is panicking if you're not forced to. Wait for it to bounce a little bit and then sell. And I don't know where that level is you'll be selling. You could be selling, where it was Friday. But we have to monitor the quality of any rally. And that's why, again, on Thursday, we sold a little bit more and actually instituted that short position. All right, folks. If you want to email me, feel free, carl@eggerscapital.com. If you want to follow us throughout the day, twitter.com/carleggers. We're on Facebook, Google+, iTunes, and that's about it. All right. Take care. We'll talk to you soon.